Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. On tonight's program, we're going to look at 4 or 5 interesting stocks: Promedicus, Xero, Splitit, Novonix, Gable Lithium, and a surprise stock by Gable. Mike, of course, will look at the technical analysis of those companies. Then we have Julia Lee, of course, from Berman Invest with her view on these companies and maybe a company that she likes or dislikes. And similarly, Jun Bei Liu of Tribeca Alpha Plus will add her insights, her views on these particular companies. And then Paul Rickard will look at Westpac, reported today and announced a buyback, but the market didn't react the same way as it did to Woolworths and CBA when they announced a buyback. We'll see why, and we'll see if Westpac is a buy at this slightly lower share price. That's the show. Well, we kick off now with Julia Lee of Berman Invest. Well, joining us as she always does, first up on the show is Julia Lee. Good to see you, Julia.
Good to see you, Pete.
Okay, so I've run through a number of stocks that people have been asking me about, and I always like to get your insights on it. Let's kick off with one that I know you've talked about in the past, and that's Promedicus.
Sure. Pete, I really like Promedicus. What we've seen here is strong growth and a really innovative product. And what Promedicus looks at is medical imaging. So basically, doctors, they can open up a file or receive a file of the image rather than those traditional days when you had to physically take it to the doctor. Now, the importance here is that these files are very detailed and they can be quite big downloads. And one of the advantages Promedicus has is a speed which these files can be downloaded, which means doctors aren't hanging around and waiting for these files to be downloaded. Now, because of the strength of their product, they've seen strong take up in the US and strong growth coming through. I mean, the only problem I have with this stock is the valuation. In terms of growth, it's been outstanding. And I guess on the flip side, if you're having a look at the potential risks, then it is a technology-based stock. So if we do see technology evolving, then that could be a negative for Promedicus. But for the time being, love the product, love the company, just don't like the valuation here. But it looks like it's all about growth here. So as long as they keep on winning new contracts, they should be able to keep the current levels.
And you kind of think, Julia, that there's probably an enormous medical world out there that isn't currently using their product, and so the potential market growth could be quite extraordinary.
Yeah, Pete, I think that's true. But the problem here is that with the current valuations, a lot of that is already priced in. So the question you have to ask yourself, where's the extra going to come from? The market's already so positive about Promedicus' story. So whether it's in terms of the R&D, and there doesn't seem to be anything huge in the pipeline at the moment. So I guess in terms of Promedicus, the only bugbear I have about it is around the valuation. Growth has been strong, but look, that's already priced in at these levels.
Okay. Another company that's done pretty well, but just doesn't seem to beat 150 is Xero. Do you think it will in coming months?
Yeah, look, I think things are looking pretty good for Xero. If you have a look at, I guess, some of the things you can look at to weigh up Xero's business, they include things like company formation, the number of insolvencies and bankruptcies, and also you can have a look at its competitor, mainly Intuit over in the US. And if you have a look at any of these measures, things are looking pretty good for Xero. Not only have they been adding capabilities to their software, which makes it very competitive and very attractive, but recently we've seen a price rise as well. But if you have a look at things like company website visits and downloads, it doesn't seem to be impacting on the new subscriber growth, which is extremely positive, not only for revenue, but for earnings as well. So look, it looks like a bit of momentum here for Xero, and things are looking very positive, whether you're looking at the lack of insolvencies and bankruptcies out there, the number of new companies forming, and that price rise just seems to have been absorbed by the market. So looking good here.
Okay, let's go to a company like Splitit, which was very popular when it listed, and the market's fallen out of love with it pretty substantially. Is there any chance the market might rekindle its affection for Splitit?
Yeah, look, I just think the buy now, pay later space has become too crowded. So that extra competition means it's very hard to stand out in the crowd. Split It, I guess, has a bit of a different product where you can use the extra credit you have on your credit card to pay off installments in the buy now, pay later space. But that extra competition means that there's going to be more costs in acquiring customers as well as merchants. So more money needs to be spent, which of course means that margins come under pressure, not to mention that it's a lot more difficult to grow when there's extra competition coming through. So look, when you see that competition intensifying, that's usually a negative signal for the share price, because it means that, the market has to be shared with a lot more players out there. So this is probably one that I'd avoid, Pete.
Okay. One area that you've always liked is the new age companies linked to electric vehicles, lithiums and batteries and stuff like that. Novonix has done really well, unbelievably well, but can keep on doing it.
Yeah, I mean, Novonix, if you have a look at the share price, it's almost gone vertical at the moment.
Yeah.
It's looking really good, but it does look like the market's maybe getting a little bit over exuberant in the short term around its share price. Now, it looks at things like battery testing. It also has an anode material which it sells to Samsung, and it's got some memorandums of understanding with some other players in the marketplace. So look, I think it's a really innovative company. It looks really quite interesting. I'd just be waiting for a bit of a pullback in terms of the share price. So I think it's looking overly optimistic where it is at the moment, and it's probably run too hard, too fast, and I'd be waiting for a pullback. But certainly, that electric vehicle story is driving so much of this space at the moment, and that's likely to continue with the emphasis on the environment as well as moving towards net zero.
Yeah, that story last week where Hertz bought 100,000 Teslas and 50,000 are going to be used by Uber. It's such a modern story, but the story is just going to get bigger and bigger and bigger, isn't it?
Absolutely. I remember once I got picked up in a Tesla when I ordered an Uber, and I said to the guy, he had, I think, 6 of them. I said, how can you justify the cost? Because they're quite expensive cars to buy. And he said, well, there's little spent that he needs to spend on maintenance besides brake pads. And in terms of petrol, he doesn't have to pay petrol either. So he actually saw it as an investment, and a good investment in that area because of the lack of maintenance that he had to pay. So look, I think that electric vehicle space is only going to get stronger. And it looks like most analysts around the globe have underestimated how quickly the pace that this is going to be adopted. And look, this is being driven not only at the consumer level, but from the government as well as institutional investment as well. Okay,
let's get another one. This actually was put to me at a lunch on Friday by a colleague who got in at very low prices. He basically wants me to tell him it's going to keep going up. But Gable Lithium has done very well. But what do you know about the company?
Sure. So this is mostly around a project over in Argentina, and it's a brine project. And when it comes to lithium, I guess there's a few things that you look at. First of all, whether it's brine or hard rock. And in this case, it's brine. And then you have a look at the grades. And the grades here have been outstanding, which is why the share price has been rising so much. So I guess in terms of the hierarchy of what you want to see in a project, hard rock tends to be more desirable, which is great news for Australian lithium miners, because generally that's what we get here in Australia. So Pilbara Minerals is hard rock. And when you're having a look at hard rock, you're looking at producing lithium hydroxide rather than lithium carbonate. But, the market is so strong at the moment that supply can't keep up with demand. And that's a great place to be, especially if you've got a higher quality product, which this company does. So lithium doing really well today on the market, and it's likely to continue to do well. Pete, one of the things I like to look at when looking at stocks is whether there's an underlying cyclical cycle that's helping the company or a structural cycle. And in the case of electric vehicles and lithium, what we're really seeing is that structural shift, which is helping. The thing to be cautious of is that commodities usually aren't too hard to get out of the ground. So what you want to watch for is the big supply response, which often comes with high prices, as a signal to get out of commodities, because lithium is found all around the world. It's not too hard to find. The problem is that it usually takes a few years for a lithium mine to get up and running. So when you do see that big supply response, usually that's a signal to start lightening the load in terms of your lithium exposure.
Okay, I'll be looking, but I'll get you to look as well. Tell us when there's oversupply, Julia.
I'll keep on looking, Pete.
That's going to be your important job. Any other stock that you've seen this week that you've liked and you've added to your fund?
Sure. We're keeping a close eye on the agricultural stocks this month, and that's because the agricultural stocks, they, instead of reporting in August, they report in November. So these are stocks like Incitec Pivot, New Farm, both of which we like. Orica will be reporting this month as well, Elders, Select Harvest, United Malt. So all of these companies we're having another look at. At the moment in the portfolio, we have New Farm and Incitec Pivot. New Farm in particular is looking relatively cheap. Now, in its half-year results, it did imply that that its result would be weighted towards the first half because we did see a bit of an early season. But if you have a look at cropping conditions in Australia as well as Europe, they have remained quite favourable. So I'm optimistic that they can beat expectations and that we're in a bit of an upgrade cycle here. So a New Farm would be my pick this week, and watching that carefully because all of these companies will report in the middle of November.
Okay, Julie, thanks for joining us.
Thanks, Pete.
Well, joining us now is my charts guy, Mike Gable from Fairmont Equities. Mike, great to see you.
Thanks, Peter.
I know you're more than a charts guy, but that's your prime function for you in my life. and we'd love you being the charts guy. These are stocks that people have asked me about. We've looked at what the analysts have said, but we always like to see what your charts are telling you. And Promedicus is an interesting one, isn't it? It's really gone for a big run, but lately has come off the boil. What are the charts telling you now?
I think it actually looks like a buy again. So Promedicus has been in an uptrend for a while. Most recently, as you mentioned, sort of towards the end of August, the shares had cooled off a bit. So they had a great set of results there, which gave it that spike up to a new high. And then, a bit of heat came out of the share price, but, the whole market was coming back during that time as well. Yeah. But what I've noticed over the last few weeks is it has, stopped falling, which is the main thing. The range has started to tighten up and I'm starting to see some buying again. So, there is a little bit of resistance around this $55 mark, but it looks like it's happy to go through that. And I think it'll be trading higher from here.
Yeah, and I guess looking at its previous high of around 65 or so, given us around 55 now, if you can make $10 on 55, it's not a bad return for a company that's got a lot going for it, fundamentally speaking.
Yeah, exactly. It's look, it is pretty pricey, and of course, if we see long-term yields go up, could affect PME. But zero debt. It's in the medical space. Yeah, look, it's a really good business, and I think if you're looking to buy it, I think in terms of timing, now's the right time because I think it will head higher.
Okay, let's go to the next one now, and it's Xero. It does go up and down a bit like the saw teeth or a teeth of a saw, but it certainly goes up, doesn't it?
Yeah, exactly. This is also another stock that's been in an uptrend for a long time, but for most of this year, it hasn't made any progress. And I guess that's true of a lot of tech companies on the ASX. They sort of peaked at the start of the year and then have failed to really kick on. In terms of the way Xero is trading here, it's, as I've sort of indicated with those blue lines, the range for the year is starting to tighten up. So in terms of charting setups, this is known as an ascending triangle. So you've got higher lows throughout the year, but there is some clear resistance around that sort of 155 level, which is where it is now. So it does look like it's at that level where if it breaks through 155, so I think if you see it push through 160, that's definitely a buying opportunity. I think the only caveat with this one is over the last several weeks, I don't like the way it was sold off quite sharply there in sort of late September, early October. So although it is back at that resistance level and we have to keep an eye out for any sort of break, I think it'll probably just spend a little bit more time around $150. Again, with what's happening with rates out there, it wouldn't surprise me that that there is still a little bit of selling at the moment for this. But longer term, pretty good looking chart.
So I guess what you're saying is if we're around 155 and we drop down to like a 145 or something like that, given what this has been doing, and also the fact that around November, December, January is often very, very solid months for the stock market, that's when Xero is likely to break out, if it's going to break out.
Yeah, exactly. But I think at the moment with Xero, it's just a case of what those long-term rates are doing, because it's trades on a nosebleed PE, so it needs to we need to make sure those rates stay low. But yeah, if they do and the market continues to kick on through to Christmas, then that could give us the breakout for Xero.
Okay, next one, Split It. This was a company that was very popular when it first came on the market. As you can see, it's increasingly lost popularity. Is there any signs that maybe that promise of this company is going to start being believed by the market?
Yeah, there are some signs that this downtrend is slowing down. So if we have a look all the way at the bottom right, that bounce in September was quite interesting. So this is a daily chart. So we've had 3 days up where this stock went from sort of low 30-cent region to the mid 40s. But since then it's drifted sideways. So I find that interesting because after that bounce, it's clear that we haven't seen a lot of selling come in and really push it down again. So again, it's not one of those sort of situations where it's sort of black and white. Okay, it's gone from being a sell now to buy. It's gone from being a sell potentially to this is leveling out, and now we just need to see that next step, which is basically we need to take out some previous highs and we need to see some good buying come in. So it's one of those ones where it's sort of early days, looks like it might be leveling out now.
Okay, it might be building a base, you're suggesting.
Yeah, exactly.
Next one is a company called Novonix. I know it was talked about in the Switzer report, probably around July or so, because I know my wife Maureen bought some in our super fund and she's been very happy with herself. This seems like a pretty popular stock as well.
Yeah, this is, it's clearly had a fantastic run. Price action in the last several weeks is sort of unusual. And the reason why I say that is after such a strong run up in July, August, September, we then had that big sell down at the end of September where it dropped from about $7 to about $5 there. When you get a sharp move down like that, normally a share price would need to just use up a bit more time and just digest that move. I remember seeing this move downwards and thinking, okay, well, I'll keep an eye on Novonix for a while. I'll come back to it a while later because it might be a buy again. What I was expecting was, if we have a look at the left-hand side of this chart, at the end of January this year, we saw something similar. There was a sharp sell-off, and then I was expecting like a bit of a flat, sort of base build again before it can get going. But for some reason, this, after dropping very suddenly, it bounced suddenly, which is a little bit unusual. But again, when you see a move like that, often it gets back to the previous high, and then you get the selling kick in. This one went up to $7. It only went down for 1 day, and it's kept going. So very, very bullish price action, probably overshot in the short term. So I wouldn't be turning up tomorrow morning and buying it straight away necessarily. I think again we can let a little bit of heat come out, but yeah, unusual, but in a good way if you're a shareholder.
But Mike, if you look at that chart, there's so many instances where it hits a high, falls away pretty rapidly, but then rebounds pretty quickly, doesn't it? Like every one of those sell-offs, apart from maybe the July-August one, but the August-September one, down quickly, back up again. The October one, down quickly, up again. go over to January where you made that point before. It seems that there's some very committed people whenever a buying opportunity comes along with this company.
Yeah, I think the difference back then in August, September was it had only just surpassed the January high. So, we had sort of 7 or 8 months of people being able to sell it, and that gave it a little bit more sustainability. So for it to breach the September high now in the space of only several weeks is, just a little bit different, but as you say, it's a sign of strength. So yeah, it's looking good at the moment.
Okay, the next company is a company called Gallon, GLN. It also has got a pretty good price chart and has had a real takeoff in recent times as well. What do you make of this?
Yeah, it's been trending very well over the last year, nice and sustainable. So even though each of the individual moves are very strong, it then pulls back a bit, and a bit of heat comes out of the share price, and then it gets going again. So I've been in and out of this a couple of times myself, just as a trade. It's a nice little trading stock. Unfortunately, I didn't see the move today because that was a buying opportunity. So basically, I put that blue line there to show where the previous high was, and the breach of that, in my opinion, was a buying opportunity. So the reason why I think this one is more of a buying opportunity on this break than the previous stock is because it just has used up a little bit more time. So we could see that after that peak in early August, it eased back, gave investors or traders plenty of time to sell out. Then it ran up to the old high near $1.30, spent the last week congesting under it, and then popped up today. So that's a buying opportunity. I know a lot of people are a bit too scared to buy something that makes an all-time high, but as we could see with this particular stock, this is the third time it's had this setup over the last year. We could see, sort of in the first quarter of this year, it did a similar thing, and again in the middle of the year. And you can see each time it breaks to a new high, it tends to kick on for a few days, and those moves are pretty substantial. We're not talking 5-10%. It makes 20-30% in a few days.
This is not a company I know all well, but I was having lunch with a friend on Friday, and he was the one who told me about it. I thought, well, it seems it's having a really good run. Is it in the lithium space, Mike?
Yeah, so they're a lithium explorer down in South America. So look,
Argentina, I think it is.
I think these ones are a little bit of dime a dozen at the moment. Everyone's jumping on that lithium bandwagon. But look, while the money flows there, it's clearly benefiting stocks like this. And if you can get involved but keep your risk management in check, I think you can do well trading these ones.
Okay, let's go to the next one. This is purely personal interest, and I have a shareholding in CGA. Contango is actually managed by my son Marty Switzer, and that they actually bought our Switzer Dividend Growth Fund. They were the managers, and they bought it, and I've ended up with shares. I'm just curious. It's done pretty well, but what's the chart telling you about CGA?
So this is a weekly chart. First up, so yeah, not as liquid as the other stocks out there. So I've just moved to a weekly chart just to get a bit more of a pattern going here. Obviously, up until the start of this year, it'd been sort of flatlining in a way, but yeah, really big move. Well, actually, since the end of those COVID lows, actually. So you're looking at a 30-cent move to over $1. But even though it's come back in the last few weeks, it still has that uptrend. If I look at all the previous lows and just referencing back to, it looks like back in March this year was the prior low. What it's done in the last few weeks is get close to that by pulling back to 80 cents and then bouncing again. So at the moment there is still an uptrend.
It's obviously driven not by the Switzer Dividend Growth Fund, which is more a very sedate kind of fund, but it is driven by the success of WCM and WCMQ and WQG, which are based fund manager, which has done very well since it's listed on the Australian stock market. So Just an interesting little self-interest. I don't do that very often, but I'm glad to see you think it's on the uptrend. I'll keep talking to my son going forward. Let's go to the next one. This is your selection, CBA.
Yeah, so I think CBA looks like it wants to kick on here. Obviously, with the other major banks, ANZ, NAB, and Westpac, they're going ex-dividend very soon. So I know the temptation is to look at those and try to get a dividend in a few weeks as opposed to in a few months. CBA will go ex-div in February, but CBA is trading better. It's the better bank. Longer term, it's delivered the return. It's delivered better returns than the other big four banks. But it's trading better here. So while the others are quite volatile at the moment, Westpac's down about 6% today. Their CBA's doing really well. So what I've noticed with the way it's trading since June, it's basically gone sideways, made no progress, but we could see that it has been forming those higher lows, which is what I've indicated with the diagonal line there. There seems to be a bit of resistance here around 106. Obviously, in August, it sort of went through that level. It came back. It looks like just that 1 or 2 days is a bit of an aberration, but generally, it's been building up quite nicely. And I think if it could start trading with a sort of a 107 or even a 108 level, then to me that would be a bit of a break, and then then it should continue on. So. Generally with the banks, I think they'll do well. Obviously, if the market's going up, the banks will go up. If the economy is improving, that's good for the banks. If interest rates look like they're going up, that's good for the banks. So I think we're in a bit of a sweet spot at the moment where we might get another kick along for the banks. And in my opinion, my advice would be, don't worry too much about those that are about to go ex-div. If you can just be a little bit patient and wait a couple of months, I think your capital will hold up a lot better in CBA, judging by the way it's trading.
Yeah, and I guess, Mike, if they hadn't done a buyback, it'd probably be a lot higher than 105. It'd probably 107, 108.
Well, it looks like it's trying to catch up now. It's as I said, every time it dips, there's been buying, so it's digested all of that, and it looks like it's ready to roll.
And I also look at it this way. If you think interest rates are rising and you're talking about a pretty big boom economic year in 2022, well, then you kind of think, well, the share price could easily go up 5%, and then the dividend plus franking's worth about 5%, isn't it? So there's 10%. So 10% is not a bad return for a quality company.
Yeah, exactly. I think you can get more than 5% return in the capital, to be honest. I think.
So I.
Yeah, I think, look, it's sitting near record highs, but, highs and records are made to be broken, and I think this one will kick on next year.
Yeah, I guess if you look at the chart for Tesla and Microsoft, you see new records get created all the time.
Yeah.
All right, Mike Gable, thanks for joining us, mate.
Thanks, Peter.
Well, joining me now is Jun Bei Liu of Tribeca Alpha Plus. Great to see you, Jun Bei Liu.
Great to see you, Peter, and it's great to be back in the office for you, isn't it?
It sure is, and I think the economy will benefit from it as well. Why don't we just go straight into some of these unusual stocks? Well, they're actually not unusual. A lot of these stocks have done well, and the question is, can they do well again? The first interesting one is Promedicus. What do you think of that company?
Well, I love that company. I think it's one of its own kind. It's actually one of the few really bright spot of the market, over a long period of time. It is an innovator in that whole diagnostic imaging space, and its software is actually being utilized by many of the top hospitals. They're in not only in Australia, actually in the US as well, and to be highly recommended. This company is stay as an innovator of that space, and it will continue to be so. Share price it's done very well over the last few years, just more recently had a bit of pullback. Our view is that that's only going to be temporary. The way it's winning contracts, even during COVID, is showing incredible strong business momentum. It's definitely a buy.
Okay, let's go to another one. There's a company I really like. it's kind of hitting its all-time high and not going much above it. But gee, I reckon next year will be a good year for it. Xero. What do you think?
Oh, I love that company too. Look, you're right. It's at $150. Certainly feels like it's quite high. However, if you look at the share price and relative, this share price relative to a few other names, I think there's more to go. Don't forget the company has yet to report. So it did have a bit of pullback, but very quickly got picked up by long-term investors. I think the result will be very strong. This company, don't forget, was impacted by the lockdown. The small businesses were impacted by lockdown. So its earning will be leveraged to the reopening of the economy as well. So my view is that it's got further to go.
Okay. Here's a company got a lot of great publicity when it first kicked off, but the market really hasn't warmed to it. But you like tech stocks. Split it. What do you think of Split?
Yeah, look, I like tech stock, but I think the payment space is getting increasingly more competitive. Share price hasn't done very well, but if you look at the rest of the payment space, most of the share price hasn't really gone anywhere in the last 3 to 4 months, simply because though things are good, the competition is picking up. It's great Afterpay and the Zip and the others, they actually sign up with large players in the US. Otherwise, you become, lack scale and, you will lose out over the medium term.
Yeah, so Split is probably too small to get excited about. Let's go to another one that has done really well, Novonix. What do you think of Novonix?
I think it's like any of those hot stock. It certainly is doing the right thing in that whole in that whole space. Look, the share price would suggest it's a little bit toppy. It does remind me of another stock called Calix. It's sort of all in that whole sort of renewable sort of space. Look, it just be very, very hot, and just be mindful of piling money into something that has done incredibly well. And in terms of the future earnings, there's a lot being built into expectations. I would much rather hold back and wait.
Yeah. Okay. This is another one. I guess it's in the uber cool space nowadays. That's Gallon Resources. What do you think of them?
Yeah. Look, again, it's in that whole EV and lithium space. It's got a good deposit in Argentina. It's early stage, so still getting drilling results and the like. It's speculative, but it's in the right space. Now, if you lithium is to buy a mining company one is you need to form a view of whether you like the commodity, and 2 is that whether it's a good company. Now, for the company itself, it seems okay, a little bit early stage, a little bit high risk. But for the lithium, honestly, there's so much demand for those goods. The price is going higher. Every contract is strike at a much higher price than what it was before. So it's there's a lot more to go for those names. My preference will be in the more established player like Orocobre or PLS. But look, that is a higher risk proposition, but it's in the right space.
Okay. So what have you learnt to like or dislike in recent times?
Look, in recent times, the market actually has been reasonably volatile. It is throwing up a lot of interesting opportunities. Even high quality big cap stocks, you're seeing those opportunities. One example was the one you talked to, Xero. So Xero recently, actually a few weeks ago, went to $130, but very quickly caught up. But other ones, Endeavour is one that you should really look at. Earnings going to reopen. Earnings going to grow higher as the economy opens up, and it's incredibly defensive. Sell alcohol to restaurants as well as Dan Murphy. So, very defensive earning. That's a good company. Another company that's been sold off a lot in the last few months is Domino's. Incredible result it delivered. And it's not just Australia, it's global, and it bought into new territory. You should be able to see double-digit growth for many years to come. But share price come up because, look, again, the market is got too hot, and there was a few people looking at it thinking whether it's a COVID beneficiary or anything else. And my view is that the result AGM that's coming up, which is this Wednesday, it should be reasonably strong. So I think that's a really good buy as well. I can keep going if I have enough time.
No, we'll say that for 2 weeks' time. But Jun Bei Liu, thanks for giving us your insights.
Thank you so much. Have a good day.
Well, today we learnt that Westpac was going to be doing a buyback, and the market wasn't all that positive. So the talk about this Westpac decision and the market reaction. We have Paul Rickard of the Switzer report. Paul, are you surprised at the market's reaction?
A little bit, Peter, because the buyback was only part expected. It's $3.5 billion. There's a bit of negative. There's a negative part of the buyback in the sense that the capital component is quite high in relative terms, which means that the fully franked dividend makes up a lot smaller percentage than normal. So the buyback's not quite as valuable as perhaps the Woolworths and the CBA buybacks were. But it might be the first buyback where we don't actually see a 14% discount. That's more like about 10%, but we'll work that out over the next 3 or 4 weeks. I guess the market was reacting more to Westpac's profit result, Peter, which, look, there were some positives, but certainly the positives were outweighed by the negatives.
Yeah, so the market has pretty well assessed Westpac as being the struggler bank, haven't they, in recent times? Has this report basically shown that the market was right?
Yeah, it has, Peter. I mean, it's still very much a fixed proposition of Westpac. I mean, there were some positives. I guess the main positive was that they got some volume growth. So their home loans were up by $12 billion in the second half. And also they had some volume growth on business banking. The negative, it looks like they've really had to cut prices. In other words, their interest margin got really badly squeezed to get that volume growth. And also because it's still in a fixed state, costs are going up. Now, Westpac says it's committed to its $8 billion cost target by FY24, but in the short term, costs are still rising because there's so much, legacy compliance work where they need more risk staff. And I think that's what the market didn't like. So it was really a function of the interest margin and cost pressures. And a lot of people are thinking Westpac was about to turn the corner. I don't really think you could say Westpac has turned just yet.
Do you think a lot of the banks are finding it a lot tougher because of the growth of mortgage broking groups? And so they're sharing, in a sense, their profits that they make from loans, where once upon a time it primarily went to them.
Yeah, and that's perhaps the Commonwealth Bank's real strength, Peter, is that it has by far and away the highest proportion of loans that are written by bank staff. And its use of mortgage brokers is high, but still not as high, nowhere near as high as the ANZ or National Australia Bank, and even Westpac for that matter. And of course, as you and I know, mortgage brokers get paid a commission. They get paid an upfront commission and a trailing commission. And that means there's effectively about 60 or 70 basis points going up front to the mortgage broker, means it's not as profitable for the bank. So, and not as profitable because of trail commissions through the loan. So they'd much rather write it with their own staff. And mortgage brokers also are shopping around to get the best rates. So banks are having to be more competitive.
Yeah, and we've seen the results from the regional banks. They're doing a lot better. And I know Suncorp in particular, they rely pretty heavily on mortgage brokers to generate business that they ordinarily wouldn't get by themselves.
Look, I think they are doing a little better. I mean, I think Westpac is the laggard of 4, as we know. And, these things take time. We've seen it with the Commonwealth Bank when it went through its problems with anti-money laundering and a whole lot of other things. It was 3 or 4 years. Westpac's, I guess, in the same situation. It's got probably another year or so before it's really in the fixed state. I think there's also just a little bit of doubt about the management team, Peter. Are really these the right people? I mean, they're an interesting group of people running the bank, and time will tell.
Yeah. Paul, do you think Westpac's a buy for the patient investor?
I think for the patient investor, down around $24, Peter, it's at a record discount now to the other major banks. It's starting to look attractive. We had about a 6% fall today. I think too big, but the market can be a pretty harsh judge. Let's just see how that plays out. But this off-market buyback will provide opportunities for some, and Westpac at $24 looks pretty cheap now compared to some of the other majors.
Okay, just before you go, A2 Milk. A2 Milk had a bit of a run up then last week, came off the boil. Is the market souring to A2, or do you think it's getting ready for a rebound?
Look, I think it's finding a bottom, Pete. I don't think there's going to be a quick rebound. A2 Milk has announced a plan last week to, get sales back up to 2 billion Kiwi dollars. It was 1.7 in FY20. It fell last year to $1.2 billion. That's $500 million of sales it's got to make out, essentially because of the collapse of its China business. It's going to be hard work for them, but they've announced a plan. The market's going to want to see some signs that that's actually happening, and that's going to take time. So I think A2 Milk, is a hold, Peter. If you own it like I do, I bought it up at too high a price. I'm going to hang on to it, but I'm not expecting a big rebound in the short term. I think they've got to get the runs on the board. Yeah. The other thing that's hanging over A2 Milk, Peter, is that we have seen a fall in the Chinese birth rate, quite pronounced during COVID, and that's a continuation of a long-term trend. And notwithstanding the government so-called getting out there and saying we want to have 3 children families, well, they're having trouble enough getting young adults to have families in the first place. So a long way to go from to get that birth rate up, but it was down. So that's the other negative. And I guess we want to see that sort of move around and get a bit more positive again. So, look, I think A2 Milk is a hold. I'm holding it, but I'm not expecting an imminent rebound.
Yeah, I guess a good sign for A2 is the fact that we're now seeing international borders opening up, and I guess the arrival of Chinese tourists again would be a good thing, but that's probably still 6 months off.
Yeah, I mean, that's all going to help. And to be fair to A2 Milk, I mean, they actually did increase share and sales last year with their so-called Chinese label brands. So the infant milk products they sell, Peter, the biggest market is in the Chinese labels goods. They don't quite command the same premium that A2 Milk gets for its English label product. And that was where it really collapsed last year. So that's what really hurt A2 Milk. That's a much smaller part of the market, but the Chinese label product that A2 Milk sells in so-called mother and baby stores right across China, its share went up. So they're doing some good things. Okay. It's just that, part of the trade's been pretty hard, and it's a tough market. So, but I think, you back them for the long term, but I think they're going to have to demonstrate some results first.
Okay. Thanks for joining us, Paul.
Thanks, Peter.
And that's the show for this week. Thanks for joining us. And don't forget, you can get more analysis on these companies and more at the Switzer Report. So go to switzerreport.com.au. Once again, thanks for joining us. See you on Thursday.